Let me introduce this session, which is called New Horizons in Distributed Solar Project Finance. And you know what's different about this session from the previous one is that in the previous session we're talking about tax equity and debt and project M&A. These are things that have been in existence and in flux, but pretty well understood since the beginning of the, I would say, the serious part of solar in the US, which is maybe 2005 or so. What we're talking about here is totally different from that. All three things that we're going to be covering in this session, as far as I know, never had happened 2 years ago. We had never seen any significant financing of a solar storage project, although Tom may correct me on that. We had never seen a solar yield co. We had never seen a solar securitization. We have now seen all three, but we are in the early stages of all three markets. And so it's an interesting time to be talking about each of them, the lessons learned from the few examples that we can point to in the real world, and then where we think it's heading and what extent it's going to impact the market overall. So we have three fantastic speakers, and I don't want to waste any of your time before we get straight to them. So without any further ado, let me introduce the first speaker, Tom Layden, who's the CEO of Solar Grid Storage. Solar Grid Storage is one of the very small number of companies that is successfully developing and financing distributed solar plus storage projects in the US right now. Tom also has a long, very well-known background in the solar industry, so he can speak to what is similar and what is different when you add storage into the mix. So, Tom.
Hello, everyone. It's great to be here. I love the guys at GTM. They're awesome. To a person, I really enjoy the GTM guys. And I really like this conference because it's like roll up your sleeves and get some work done. So that's all good. So I'm going to talk about solar plus storage, which is kind of a hot topic these days. And there's so many things that we're doing that are similar to the growth of the solar industry. Most of the people in my company come from either Powerlight, SunPower, and SunEdison, so we were involved in the pioneering of large commercial solar projects. And it's so similar to what we're doing now and pioneering PV plus storage. There are basically three things driving this right now. One is because of the extreme climate events, there's a big desire to have backup storage. And so that wasn't really there before. And policymakers and regulators, they're all talking about having some kind of emergency power after Sandy. The other is with the intermittent nature of renewables, there's concern about the intermittency of it and how it will destabilize the grid. I think that's way overblown, but that is a driver. And then third, in the solar industry, because it's become so competitive, companies, solar developers who are our primary customers, they're all looking for a way to have a competitive advantage and bring more value to the customer. So again, looking back at the solar industry, we're mimicking that, we believe, in the storage industry. When I sold the first 75 kilowatt system in Pennsylvania in 2002. That was the largest PV system in Pennsylvania for years. And that was a combination of price and value at the time. And so as prices come down and we got better at what we were doing, the systems got bigger and bigger. And 10 years later, we did a 9,000 kilowatt rooftop. So that kind of progress we saw in the industry, in an inverse reaction to price and the value that we brought as an industry. And I'm seeing that, we expect that to happen in the storage world too. Our first project was 250 kilowatts, single system. And as that cost comes down and we bring more value to the equation, we believe we're gonna see the multi-megawatt type systems out there. And in fact, we're already bidding on some multi-megawatt projects. And of course, with the California procurement happening at the end of the year, that is an opportunity for some very large projects, and I believe the best value will be PV plus storage. So the way we do this, we're integrating a product. It's basically a plug-and-play system that has a dual-use inverter that does all the normal PV functions, plus it charges and discharges the battery. So when you have PV plus storage, it's a lot more valuable than each one independently. There are a lot of things you could do with PV plus storage and ways to monetize that, which I'll talk about in a minute. And so what we do is we offer that package to a solar developer who uses what we provide instead of their normal inverter. And by doing that, they're bringing a lot more value to the customer. And the way we do it, they're actually lowering their cost. So some of the values of having PV plus storage, I mean, clearly we could provide the normal inverter services. And one of our models is just to finance our assets separately, the inverter and the storage separately, and just provide the inverter as a service. Emergency power, when power goes out, you can continue to operate the PV system, which is not what happens today. And then there are emerging opportunities in these ancillary service markets for grid operators where they're developing markets. And the first real significant one is in PJM, where they have a significant market for frequency regulation. And then you get the 30% ITC. There are other things you could do with it: spinning reserves, peak demand reduction, black start. And then even on the distribution level, there are a whole bunch of values when you have PV plus storage in the distribution system that the utility could benefit by. Ultimately, what we want to do is find ways to monetize all those benefits and then balance and use them as we optimize the value of each system. So we're talking about finance. Again, our primary model is to finance the inverter and the storage system separately. And we actually have two investors, so the PPA investor and our investor. We install the system. It gets placed in service at the same time. Both investors get the 30% ITC. And there are ways to make both investors comfortable contractually. The PV investor gets full priority on the system, so there's no change on the output, but they get all these other additional benefits. So that's our primary model. We could sell it cash as well and then operate for them, or you could find an investor that will invest in the entire package, both the storage system and PV together. And the advantage of that is it's simpler, obviously, because you have one investor. But our piece of it actually gets a higher rate of return, or at least at this point demands a higher rate of return because of the level of risk, because it's a new asset class. So on the financing side, there are some serious challenges with this because it is new. And anytime anything is new, there's risk, and investors are concerned about that, so fair enough. We compensate them for that by giving them a better return somewhere in the mid-teens, unlike in the solar PPA, which is somewhere between 4.5 and, say, 9 at this point. We could provide 12 to 15%. And again, if you blend those together, you can get a really good rate of return, somewhere around 10, 11%. So it's a new asset class. That's the key thing. We're going to try to use all the conventional solar structures. It's the same thing. And again, because we came from SunPower and SunEdison, that's what we did. Figure out how to bring value to the project and figure out how to finance it with all the benefits and revenue streams. There's perceived risk, of course, with the technology. So storage is a brand new thing, especially getting it financed like this. And storage has come a long way. And we're using battery storage right now. We're agnostic to what storage technologies we use, but right now we're using batteries, lithium-ion batteries actually, because now with lithium-ion batteries you have 10-year warranties from bankable companies, and the chemistry is good for the way we use it. The other thing is if you're bidding into the markets, that's non-contracted revenue. So that's probably the biggest bugaboo of all, that we don't have contracted revenue. And so we try to convince our investors that there's a pretty good history on what we do. There's a pretty good forecast of what we expect the values to be. And in fact, the experience that we've had to date is really quite good. And then there's one other factor now. There's some confusion about the ITC when you have storage plus PV or storage plus renewables. There have been a couple of PLRs out there that people know about that touch on the subject. Very confusing. We think IRS is looking at this wrong, actually, and we're talking to IRS to see if we can get a better ruling in that. So what do we do to overcome these objections and provide comfort to investors? And when you provide comfort, that means the cost of capital goes down. And again, just like the solar industry, I think you're going to see, as we get more operating experience, that investors will get comfortable with it. So lock down revenues if you can. We are talking to some utilities that would provide us a strip that would provide at least a floor on revenues. We are working with companies that provide bankable warranties, so both inverter and battery storage, so that provides comfort. We're looking at hedging strategies. So because it's a market, the way we use the system, mostly in frequency regulation right now and PJM, how do we hedge that and provide a level of comfort there with the investor? We want to clarify with the IRS what the ITC status is. And then, most importantly, I think it's just a matter of delivering on projects and getting some track record, and that just takes time. Again, just like the solar industry, the 50 kilowatt system, 75 kilowatt system we sold 12, 14 years ago, every time you put one of these in, people get a better understanding of how it operates. And over time, people became very comfortable with the predictability of the production of PV. We expect the same thing to happen in storage, PV plus storage. So who benefits by all this? I mean, this is one of the exciting things for me personally. I've been in the solar business for a long time. I jumped into this rather than just developing PV projects because I think there's so much value to it, and that if we're going to take the next step in the solar industry, that we need to have storage. So here's a way to do that, and when you look at the universe of stakeholders, everyone benefits by it. So our primary market are solar developers, and for them, it's an opportunity to offer a differentiated product from their competition and provide more value to the end customer. So the end customer, obviously, backup power is the number one thing that they are concerned about, and that's something that there's real interest. We've won a couple of projects, public projects recently, where the PPA, because we were in it, the PPA actually got more money per kilowatt hour. So even though our offering actually lowers the cost to the developer, they were able to get more for their PPA, half a cent to a penny a kilowatt hour, which is a big deal. And in fact, we won a couple deals that were higher than the competitors, but they didn't have storage. So that's an exciting prospect to the developers, obviously. And it just shows the desire, at least on the East Coast, especially on the East Coast, I should say, for backup power. The utility likes it because it provides some local distribution benefits. Volt-VAR support, power quality, a lot of different distribution benefits that they are glad to have in place. And then the grid operator, of course, they're trying to keep balance on the grid all the time, and so power is coming in and out. And if we could provide a buffer, which is what our system does, then that's something that is valued by them. And PJM has put together a program that actually values fast reacting power, which batteries can provide, higher than any other frequency regulation asset. And then at the end, the PV industry, this is all about accelerating our growth. That's where we need to be. And having storage in place is one way to break down some of those obstacles. So there's been a lot of interest in this. For a small company, we've gotten a lot of press. It's been fun. And again, it's like 10, 12 years ago, where every solar project, there was a dedication ceremony, the governor would come out, blah, blah, blah. This is exactly what we did for the last couple of projects we put in. The Contera project, that's Governor O'Malley from Maryland, that's Chairman Wellenhoff from FERC came. And we haven't seen that kind of excitement in the solar industry in a long time. It's just kind of run-of-the-mill, these projects, one after the other now, which is a good thing. But it's exciting that with storage. People are excited about it again. So I only have a couple minutes of just a little editorial. So there's all this discussion about intermittency of renewables, and I said earlier, it's way overblown. The more renewables you get in, it actually is better. It becomes less of an issue. So you can see in this graph that wind and solar, you do have the intermittency, and that is an issue. When you have storage in place, that softens that. It buffers it. And then California has shown that when you put a lot of solar in, that it kind of hedges one against the other, and it's really not much of an issue. PJM just came out with a study that said we can do 30% renewables, absolutely no problem. Germany gets 40% of its power some days. Germany's not blown up. So there's ways to do this. Don't let anyone stop us from getting this stuff in the ground. And I like being part of the solution to it and just taking that argument off the table completely. So here's where I think we're going. We are moving to distributed generation. There's absolutely no question about that. Storage plays a really good role in that, in almost every aspect of distributed generation. And if we're going to use the grid that we paid for and use it efficiently, this is what you need to do. Distributed generation needs to be added into it. Storage needs to be added into it. And that's where we're heading, and that's the most logical thing. The utilities have been reluctant to go along with this, but I could tell you that in my discussions with utilities, they're getting it now. And at high levels, we're talking to people, even though their culture is hard to move, there's definitely keen interest in it. And I think you're going to see utilities becoming more involved. And in fact, I think there's a real role for utilities to play in storage. So that's what I got, so thank you very much.
Fantastic. Thank you, Tom. And I have dozens of questions that I'll not have a chance to get to in just a few minutes. In the meantime, the next speaker is Tuan Pham. Tuan is the president of PowerFin Partners, also an old friend of GreenTech Media, and we wanted to have him speak on the YieldCo session here in particular because about a month ago or so, he penned an article that we read that I thought personally was one of the more thoughtful, thought-provoking pieces on what we should really make of YieldCos given how exciting they seem to be to everyone in the industry. You can even see this in the previous session, which wasn't about YieldCos. YieldCos were mentioned 5 or 6 times. So it's hot, but how much are we supposed to care and how much is it really going to impact the market? So Tuan is here to tell us. Tuan?
Yeah, well, thanks, Shale. I've always appreciated GTM's perspective on the solar market, and it's a great platform for people to get information out there to positively affect the market. So a little bit about PowerFin Partners. We invest in and develop solar projects primarily here in the U.S. So with that, I'll just go ahead and get into some of these slides. So just a brief overview here. I'll just address kind of the overview of YieldCos, the basic mechanics, get into a little bit of YieldCo valuation with a little bit of sensitivity analysis there so that we understand what the risks are contained within the YieldCos. And then also just kind of summarizing. So starting from the top, what is a YieldCo? Effectively, and I'll just be very basic with the assumption that, starting very basically, it's a publicly traded stock. It's a C Corp that holds generating assets of any kind. And the reason why it's popularized is because, over the last few years, a lot of people have been talking about REITs and MLPs, inserting them into, or inserting solar generating assets into those structures. The idea being that solar generates very stable cash flows, which can subsequently be distributed to an investor base that likes to clip coupons, so to speak, like bond investors. And so the difference between a yield co and those other vehicles is that it mitigates any sort of tax structuring problems contained within them. So yield cos mitigate that problem, and that's because they're C corporations. So not to get too much into the tax specifics of it, but these yield cos are mandated to distribute specific amounts of dividends to shareholders. And it's very fixed, and that's actually why solar is such an attractive asset for these yield cos, is because the sun comes up, sun comes down, operating costs are very well known, and so we know how much cash flows are going to come off of it. And so after asset management fees, those cash flows are distributed mechanically to the investors, and so that's very attractive to your retirees and annuity type investors out there. So these yield cos, they're affiliated with sponsors, and I've referenced a couple here. NRG and Pattern Energy have some yield cos outstanding, and those sponsors, effectively, they provide a pipeline of projects to populate that yield co. Some of them may already be generating. Some of them may in the future be generating. And so in the future generating, post-COD assets, the yield co would own a right of first offer or right of first refusal on those projects, therefore giving those investors some visibility, the yield co-investors some visibility into what to expect in the future as far as dividends and growth off of that yield co vehicle. But effectively, a yield co is kind of a hybrid between a stock and a bond. Bond, it's if you were to value it, it's based on a yield-based valuation. So whatever I'll get into the details of that. It's kind of like a stock because it's publicly traded, and there's price risk contained, which I think oftentimes is overlooked here as we kind of look forward. And I'll again get a little bit more into it. What's attractive about yield cos, they provide very steady dividends, and they're actually higher than what most bond yields are offering today. So somebody who doesn't want to make, 0.2% on a CD, they may be willing to invest in a yield co that might be able to offer 5 to 6 or 4% yields. Now, those are, in my opinion, pretty low yields, but some people, they like that. Another advantage of a yield co is that you can pull it up and you can see it on Yahoo Finance, for instance, and you can log into your Schwab account and you can buy and sell it. So it's very liquid, and that certainly helps with the valuation of the instrument. Another thing that's attractive is that there's transparency. You know that an operating company or the management of that company is not going to come in and inappropriately deploy capital into projects that don't make sense. So you have a generating asset that just generates cash flow and nobody can stop it. Even incompetent management can't stop it. Another thing is, as I previously mentioned, is that it mitigates tax problems that are introduced by REITs and MLP structures. So this is just kind of the mechanics, and on the top here in the blue box or in the blue circle, you have the sponsor that develops projects, and then you have the yield co at the bottom, and they're two different entities. The yield co at the bottom, they manage and they hold the generating assets, and then they distribute the dividends, as I was referencing. And so when a project that's either being developed or is currently owned by a sponsor like NRG or Pattern, it has a certain yield profile, one that's higher than or equal to the return requirements of the yield co. They drop that asset down into that yield co. And so there is, however, a conflict that exists between the sponsor itself and the yield co, in that the sponsor, they want to, sell at the lowest IRR, and the yield co wants to buy at the highest IRR, or they want the best yielding assets. So there's a conflict there, and there's some, there's a wall between the two entities and some kind of, checks and balances, so to speak, to prevent those conflicts from occurring. In any case, just moving on here, this is this formula here is basically a dividend discount model formula. It's a very simplistic or it's a very simple and yet elegant way to determine what the value of a corporation or an asset, how it should be valued. So on the left-hand side, you have the YieldCo value, or the price per share of that YieldCo instrument. And then on the top, you have the dividends that come off of that entity. And so you divide that dividend by the internal rate of return minus the growth rate. And so the dividend here is just basically the revenues minus the operating expense minus asset management fees. As previously discussed, that's very stable. It's with renewable assets, because there aren't any commodity risk contained in them or fuel price risk, it can be very reliable. The IRR, that's just basically the returns that the investors demand off of that particular stock in this case. And so, the IRRs, how do you determine that? Well, that's the treasury rate, which is the risk-free rate, call it for 20 years, plus some sort of risk of default or operating uncertainty. So if you have 2.5% treasury rates and 3% default rate assumptions, then your IRR or in your investor hurdle rate should be about 5.5%. And then, of course, you have your growth rate, and that growth rate, at least specific to solar, is driven by the panel degradation and the OpEx, or the operating expense inflation. And then also to some extent, and it gets a little fuzzy, portfolio growth expectations. So the sensitivity analysis, basically using that same formula, if, and I'll do this for IRRs and then for growth rate assumptions. IRRs, if you have a 6% base IRR assumption, let's say that your stock should be worth about $50. If, however, your IRR assumptions, you say, well, I don't need to really make that much money, I'm going to go ahead and buy this thing at a 5% IRR, well, then you would be willing to buy that stock at $100. And then vice versa, is that if treasury rates, for instance, increase, then your valuation on your stock is going to go down. Just plug it into the formula. Same practice here for growth rates. Let's assume that your annual growth assumption or your terminal growth assumption is 4%, $50. If your growth assumption increases to, say, 5%, only by 1%, you have a doubling in the stock price. So it's highly sensitive to what your growth assumptions may or may not be. And likewise, 1% lower growth assumptions, $33. So there's a lot on this slide, and just kind of in the consideration of time, I'll try to get through as much as possible. But I've just broken down those three different components of valuation, and then talking about the opportunities or pros and the challenges for each. So on the dividends, solar generates stable cash flows, and there's transparency of operations. On the challenges there, are the default assumptions correct? We don't know. Is panel performance and long-time system performance, are those default or credit risk assumptions for the off-taker or the customer, are they correct or not? We don't know, and it starts kind of looking a little bit, well, I won't get into that, but ask me later. Maintenance of underwriting standards overall, though, is key. And that's kind of one of the things, is that as these vehicles proliferate and grow, there are only, maybe 200 people in this room? If everybody in this room did this, you would still potentially throw if you reached a critical mass for these projects, you would potentially throw the underwriting book out the door so that you can underwrite $200, $300, $400, $500 million of projects consistently. So are you going to be able to, so it's a challenge to the industry in some ways to try to maintain and understand what the underwriting standards really are, so that we don't get too far ahead of and feed the financial beast that needs to be fed. So IRRs. Investor IRRs are currently very low because treasury rates are historically low. Eventually they're going to come up, period. And then also, on the pro side is that 5 to 6% yield co-yields are higher than most bond returns. Let's see here. So, and also here on the right, the challenge is, because a yield co, for instance, requires a 5 to 6% dividend yield, that doesn't necessarily mean that that 5 to 6% is going to be available to that project, because there's a premium, asset management costs and, also transaction costs that occur. And so you can't necessarily say, okay, well, I see that NRG is currently trading at 4.5% yield, so I'm going to put 4.5% into my model, and then I'm going to spit out a 3-cent PPA, right? I mean, that just isn't going to work. So, and then also, on a pro side, growth for solar, adoption overall is accelerating, and I think that macro investors look at the sector and they say, well, this is a great vehicle, and undeniably it is. I think we're all here, and it makes a lot of sense for people that integrate more solar, but how they do it, is another question. And so overall, I mean, access to this cheap capital, it is pressuring, other capital providers in the industry to lower their rates of return, in theory. So we'll see what happens as far as execution goes. And as far as that goes on the growth perspective, the challenges, I mean, not all companies, very few companies, in fact, will be able to execute this. And so what's required to execute this? You have to have a lot of liquidity. You got to get projects to COD. And a lot of people, they can't get the capital to get their projects to COD. So it's very theoretical. And in practice, the list is very, very short as far as the companies that will be able to issue yield co vehicles. And then also, of course, quality projects, who knows? So let's see here. Yeah, so I'll just get into this last slide, just a little bit more time. In conclusion, yieldcos, solar is a great asset for yieldcos, long-lived and stable solar asset, and stable cash flows. Yieldcos, in reality, I mean, in theory, rather, they can cause a massive paradigm shift. It is actually the one instrument that's come into the market that has a lot of people concerned, existing capital providers concerned, because you have more direct connection to investors who require de minimis returns. Treasury rates, they're a double whammy, because low treasury rates mean that, of course, your cost of capital is going to be low, but secondarily, it's going to negatively affect, if treasury rates go up, growth assumptions are going to go down. So it cuts both ways. And right now, it's beneficial, like it's doubly good. So when it's not good, it's doubly bad. So investors looking for a bond-like return may be misguided. I'm out of time. But most of all, pipeline for viable projects for yield co-growth is key. And in summary, actually, so you think about the price sensitivity. If you only require 4 to 5% return, and you think that that's fine, you better be prepared to hold that thing for a long time, because if growth assumptions go down, or if treasury rates go up, you could have your stock that previously was at $50 go to $33. That's a $17 difference, right? So you've got to hold on and clip that coupon to make up that $17 loss for a long time. I think that's something that a lot of people, retail investors might be overlooking, and their brokers are probably overlooking it too. So, thank you.
Thank you, Tuan. That was a fantastic overview. Oh, why are we going backwards here? We'll skip through a lot of this. So I probably should have mentioned this before Tuan's presentation, but just so you know, you're all going to receive a pop quiz on the sensitivity of yield co-valuation to growth rates before you can get your drink at the reception. So I hope you're all paying attention. Our next speaker and final speaker on this session is Mike Mendelson, who's a senior financial analyst at NREL, the National Renewable Energy Lab. And my editorial is that his title doesn't do him justice. Some have called Mike the godfather of solar securitization. or if they haven't, then I hope that they will. Mike is one of the leaders of the Solar Access to Public Capital initiative at NREL, or SAPC, which is NREL's initiative to foster and accelerate solar securitization for distributed solar in the U.S. has done fantastic work, and Mike's been at the center of it. So we're excited to have him telling us what he's learned so far in securitizing distributed solar.
Thanks, Shale, and thanks for having me here. I'll try to live up to that dubious introduction, actually. But so I'm going to give a little background on our SAPC initiative and another initiative called Banking on Solar, which is designed on the retail lending space. Give a small plug for that, and dive into the SolarCity securitization numbers and try to glean some information out of that. If we look at capital markets, there's two primary things that the capital markets require, and that's consistency in the assets and the cash flows so that they can be pooled into securities or other financial mechanisms, and also the availability of both data and due diligence tools that the investors can get comfortable with the asset class. So our job, or what we're trying to achieve, is to sort of facilitate both of those primary objectives so that these assets can get pooled and investors can get comfortable with how they operate. So we started SAPC, Solar Access to Public Capital, to sort of fill in a lot of key variables. And we have now over 200 members, all the leading developers, 35 plus law firms, investment firms and capital managers, other advisory, accounting, engineering, and so on. If you're interested in participating, just let me know, because we're a pretty open tent, and happy to have both regional and national players that are stakeholders in this industry. Our activities are sort of on four pillars that we're trying to support the industry's endeavor into these capital markets. Both standard contracts, residential lease, and a commercial PPA are two that we've put out so far, and we're working to develop the next suite of contracts. And I mentioned that we have all these law firms looking at it. So our assets have been diligenced by dozens of law firms, and I think the idea there is to not only allow the cash flows to be pooled, but also speed the transaction costs and increase the velocity of deals getting done. We're developing data sets, including on the technology side, OSPARC for Open Solar Performance and Reliability Clearinghouse. That's being developed by a firm called SunSpec. GTM is going to provide value-added services on top of the OSPARC platform. So if you provide your data, GTM will provide a lot of critical analytics on that. So this could be a really valuable tool for developers to really understand how their assets are performing and be able to explain that technology performance to potential and existing investors. And we're also looking at credit performance. That's such a key aspect. Our customers paying their bills, and what does that look like? And working with a lot of developers to sort of develop that critical data set. So again, getting investors comfortable with the asset class, both on a technology and a credit perspective. We're developing best practices in O&M and installation and in independent engineering, so that we know that assets that reach the pool are well built and well maintained, because investors don't want to have to do the due diligence. Do these assets all fit into a high quality standard? We want to be able to have an industry perspective that sort of a gold seal that investors can find comfort that assets that reach the pool are all well built and well maintained throughout the life, and producing not only energy but cash flows, which is what really matters to investors. And also Tim Keating, also from SunSpec, he's leading up NREL's effort to organize the industry around this O&M protocol. So feel free to talk to us afterwards. We're happy to engage all of you in the dialogue. We think it could be a valuable asset to the industry. And lastly, we're really working to develop mock securities. So we're going to all the rating agencies with a hypothetical portfolio of assets so that we can understand how they look at the risk perspective on the industry. And we've developed a residential pool, both with detailed term sheets and cash flow analytics, and brought that in front of now 5 rating agencies to get their risk perspective. And we think that'll provide us a lot of valuable feedback. How does the rating agency and the investor community see our asset class? And what can we do to sort of structure the assets in a way that facilitates investor confidence and liquidity? Our commercial mock is underway or in development, and we've had a lot of really valuable in-kinds contribution from top law firms that are involved in securitization of one asset or another. So hopefully these will be really valuable term sheets and things that people can utilize that will be really help firms get up the securitization space a lot faster. And finally, we're sort of promoting all these different assets to both the solar and the investor communities, working with Structured Finance Industry Group, SFIG, the Socially Responsible Investor Networks, and sort of other groups to sort of get the word out, get people more comfortable with this asset class. On the mock securitizations, I mentioned we're doing a residential and a commercial. We're also sort of looking at different components, both a pre and post recapture, whether it includes tax equity or not. Of course, to include tax equity with the securitization debt is a significant complexity. So it's something that if we can get beyond that will really help the industry, we believe. And then various iterations of tranching and over-collateralization and so on to sort of, these are different tools that the securitization industry uses to get comfortable with that the payments under the securitized debt are going to be there as expected. I mentioned our first pool of residential is in front of the rating agencies now, and hopefully we'll get some good feedback, including actual ratings. We've developed with that a senior substructure, sort of a multi-tranche way to develop the assets. So sort of looking at complexity that's above and beyond the way Solar City did their first 2 securitizations. I mentioned the Banking on Solar group. So where SAPC is really trying to engage capital markets, Banking on Solar is trying to get the lending industry more engaged and available in this space. So we now have, even though we just started early this year, we have about 60 participants in this working group, and we're working to standardize loan documents and underwriting principles. Again, sort of working with regulators and lenders to bridge the information gap and also create assets that banks and other lending institutions can get more involved in the space very quickly. Also looking at the weighted average seasoning, we're seeing that the assets have been operating for a shorter amount of time. We're getting more comfortable that the assets are going to perform just fine if with only a year of operation. The percentage of the asset pool that was just from residential went up. So in the first securitization, it was about 29% commercial. Those were all commercial assets with really strong credit rating off-takers, Walmarts and Kohl's and things like that really provided a lot of security to the pool. The rating agencies were more comfortable creating a pool that was really almost primarily residential in this second case. So I personally see that as sort of a valuable trend that I think investors and rating agencies are getting more comfortable that that residential systems are going to perform and pay out as expected. Let me just go back quickly. So they were both BBB+, and they were both single tranche. And I think the reason they were both single tranche, even though you can get more complex and offer investors more opportunities with multiple tranches, is that these were still relatively small deals. that if you, most securitizations could be $200, $300 million of assets, and then there's an opportunity to sort of tranche out the payments so that you can provide different sort of products and services to different investor types. But here, these are relatively small. Hopefully, we get to the place where we can create a multiple originator securitization, where if we do have standard contracts and we do have consistency in the way assets are built and maintained, then we can pool these assets across multiple originators, and it sort of becomes a warehouse or a conduit, just like your local mortgage broker can sign a mortgage, but he's using standard HUD paperwork, and that mortgage goes into a much larger pool, and it's not so important who writes it, but just that it conforms to standards. Looking quickly at SolarCity, one big concern of the rating agencies and the investors is, will customers pay off their bills when the assets sell, when the home sells, or more importantly, during sort of events of default or divorce or death, things like that, sort of more stressed scenarios. And importantly, we're seeing that under a normal sale, you have about a 99% recovery of the assets. So somebody new takes over the home, and they're picking up those cash flows, or the system's getting paid off fully. In those periods of stress, those stressed scenarios, we're seeing a 92% recovery, and a 98% overall. So that's really great for the industry that this data is coming out. It just shows that people see the value of the solar system, whether they're buying the house or they're sort of acquiring the system in one form or another. It's providing value, it's providing savings against their utility bill. And this is the type of story we're hoping to tell on a much broader industry perspective through our credit performance data set. This is a complicated slide, and I'm not intending you to read it all, but the point is that securitizations are really complicated. This is a diagram from our mock securitization that we put in front of the rating agencies. And the reason they need to be so big with hundreds of millions of dollars of assets over time is because there's so many people that take a cut. You know, there's a transition manager and a O&M manager and a trustee, and it's a big, complicated process. And this priority of payments, the waterfall, that needs to be really specified through all these legal documents can be a complicated, time-consuming process. So it's just a little insight there. Hopefully you'll be able to look at it more closely if you're interested when our term sheets become available. And that's about it. So thanks very much.
Fantastic. Thank you, Mike. So we have a few minutes for questions here, and I have a barrage of them that I'd love to ask, but I want to make sure that we leave a chance for any audience questions, if there are any, for either the whole panel or individual panelists. So if you do have a question for anyone on the panel, stick your hand up. Don't be afraid. Right here.
I've actually got two questions. First to Tom about the solar storage. You talked about PJM.
There's a mic coming your way, actually. Hold on one second.
Thank you. You talked about PJM valuing the fast-reacting assets in storage. How do they monetize that? Is that through you or through the customer? Do you bid that?
So we bid in through a network operations center. So they send a signal to our asset, and then we either charge or discharge the battery instantaneously.
So you do that, not the customer of your product doing it?
Customer has nothing. This is all behind the screen.
Okay, that was my question.
Yeah.
And my second question is more to the panel, hopefully. What do you see as the biggest risk in the investing community's mind? Is it default? What's the great unknown that always keeps coming up? You know, Tesla or even General Motors never expected a recall. We haven't had a big recall in the industry. Fluctuations in debt. What's the risk?
Yeah, as I mentioned, I think that Treasury rate risk is significant. As I stated, it cuts both ways. And then, of course, growth assumptions that are baked into at least yield co-valuations, because you're not necessarily guaranteed, as you would be a bond, residual asset value at the end. Although, I mean, you know, solar does have residual asset value, but it's a long time.
I would add, if we're talking about, you know, black swan risk, I think a long period of decreasing retail electricity prices, which nobody really expects to happen, but a lot of these PPA or lease contracts for distributed solar assets are built off of the assumption that retail rates will continue to increase over time, and to the extent that that doesn't happen, as unlikely as it may be, that's a big, you know, recall style issue. Anything to add?
I would agree with that. Something rating agencies definitely bring up. I definitely see inverters as a big question mark. Rating agencies and investors seem to be really concerned, you know, will these inverters hold out? That's a big expense the biggest expense coming up that's unknown. The lifetime of the inverter, yeah, primarily. And then just, you know, technical performance. Will the systems degrade faster than expected, or will they produce as expected? And will customers pay their bills? That sort of credit performance. You know, if we're seeing technology degradation, will customers pick up on that and then stop paying their solar bill?
Any other questions from the audience? I see one right.
I've got one right here.
Oh, sorry.
Okay. This one is for Tom as well. Echo is a little bit disconcerting. When you combine storage with PV, given that the storage is generating these attributes that you're selling back to the utility that would negatively impact kilowatt hours, how do you work that from a financial standpoint so that the PPA is made whole while you're still able to sell these other attributes?
Because we only use what the solar system does not need with the inverter. So we work outside the solar curve. So solar gets 100% priority with the inverter, which is only about 15% of the time. And then 85% of the time, including all at night and so forth, we're able to use that asset. And the way we're using it in PJM, just make clear, is that power goes in and out at the same level. So it nests to zero every hour. Those are the rules of PJM. So we're not using energy, it's power, instantaneous power in and out. So the end customer is not affected by that at all. And everything we're doing, as far as the customer is concerned, is behind the screen to help them, to help us pay for those assets that they desire to have for emergency power mostly.
Great. We have time for just a couple more. I see one right here.
Yeah, this is again for Tom. Question on the storage. You probably know the technology better since you sell it than most people in the industry. When do you see it being viable economically for a residential user? How long and what has to improve in the?
Yeah, it's still not cheap for residential. We're actually looking at how we can aggregate a whole bunch of residential systems and do some of the things that we do to monetize the asset, again, outside of the inverter curve. So by and large, I think what you're going to see over the next like 3 or 4 years is a lot of creativity in storage, and we'll see the same kind of cost reduction, same kind of value add that will make it much more interesting to the residential customers as well.
So stay tuned for GTM Solar Storage Summit 2015. I see one more question here.
Who's the regulator for the securitizations?
It's a question for Mike.
It would be the SEC. But the Solar City and near future securitizations are expected to come under Rule 144A, which means they're only available to qualified buyers, pension funds, and big institutional investors. They're not retail products yet. So there's a reduced level of regulation for securitizations that come out into the Rule 144A market.
Okay, so I'm going to finish this off with one question that I'll ask to each of you in turn that is related but slightly differently worded for the three of you, and it's couched around the idea of how much should we care, we being the solar industry, about each of these things. And so I'm going to force you to answer quantitatively here, and we won't hold you to your answers. And the question is basically, in 10 years, say, what portion of the distributed solar market will be included in what you are specifically talking about? So Tom, in your case, I'm asking, in 10 years, what portion of distributed solar projects will include storage? I'm looking for a number.
Yeah, come on. Solar's like dog years. I mean, you can't guess 10 years ahead. But you asked me the question. I think every single solar system, every single renewable energy system will have storage attached to it.
That's 100%.
100%.
There we go. Tuan, what portion of distributed solar assets will be placed in yieldcos in 10 years?
It's really hard to say, but I think more than 50%.
That's a big number.
Yeah, I think that yieldcos, if properly managed, that's the big if properly managed, they're kind of this way for people who own rooftop systems or are leasing rooftop systems to pay themselves back.
Okay, Mike, in 10 years, what portion of distributed solar assets will be securitized?
That's a tough one. Well, first of all, I guess I just want to say that, got a lot of echo here. The assets we're trying to build, standard contracts and best practices, aren't necessarily a securitization thing. They're hopefully supportive of all sorts of financing mechanisms, and that projects can be sold into yieldcos a lot faster, as NRG and other yieldco managers are looking for assets that they'll have less due diligence to apply to regionally developed assets. But I could easily see, 50% of the market having securitized debt on it within the capital stack, but not necessarily, much more than debt is on current assets.
So is that overlapping with yieldcos? The same project could have securitized debt and then be placed in a yieldco, or are these mutually exclusive?
I don't think they're mutually exclusive. No, I think you could have securitized debt and then the remaining equity goes into yieldcos or.
Yeah, it's like rocket fuel.
So the short answer is we should care a lot about all of these things. Please join me in thanking our panelists.